Okay, so you want to own a hotel. Find a building, put your name above the door, hire a polished front desk staff in matching uniforms, and watch guests check in every single night of the year. No manufacturing, no inventory that expires, no product to ship, just rooms, beautiful rentable rooms. A 200-room hotel at $180 a night, full every night. That's $13 million a year flowing in before you've sold a single drink at the bar. That's the mental picture. That's what the glossy brochure is designed to make you feel. Here's what the brochure leaves out. The logo on that hotel sign. The company behind it almost certainly doesn't own the building you're standing in. Marriott International, the largest hotel company in the world, owns fewer than 1% of the hotels that carry its name. Hilton owns almost none of theirs. IHG, the parent company of Holiday Inn and Intercontinental, operates on the same principle. These are not hotel companies in the traditional sense. They are brand licensing businesses that collect fees from people like you. People who built the hotel, bought the land, hired the staff, and took on all the financial risk in exchange for the right to hang their logo on the front door. So here's the real question nobody asks before signing the construction contract. If the most powerful hotel brands in the world decided decades ago that owning hotels was a bad idea, what do they know that most first-time buyers don't? Walk through the lobby of a busy upscale hotel on a Thursday evening. The bar is loud, the front desk has a line, every elevator is moving. The valet stand outside looks like a parking lot for German engineering. It looks like one of the most reliably profitable businesses a person could own. It looks like the owner should be somewhere comfortable watching the revenue stack up. The owner is usually somewhere uncomfortable watching the occupancy number on a dashboard, calculating whether this month's RevPAR is going to cover the debt service payment that arrives in 11 days, knowing that if it doesn't, the conversation with the lender is going to be the worst phone call of the week, and most weeks, there is a version of that call. Before we even get to what a hotel earns, we need to talk about what kind of hotel you're actually buying, because hotel is a word that describes about a dozen completely different businesses sitting on the same real estate. At the bottom end, a budget or economy property, a roadside motel, a limited service chain, charges $70 to $110 a night, runs a small staff, offers no restaurant, no pool, no meeting room. The business model is almost entirely about occupancy, fill the rooms or lose money. Above that, the mid-scale and upper mid-scale segment. Hotels like Courtyard by Marriott, Hampton Inn, Hilton Garden Inn. These charge $120 to $180, offer a lobby bar, a small fitness center, maybe a hot breakfast. They attract a mix of business travelers and weekend leisure guests. Then there's the upscale and upper upscale tier, a full-service hotel with a real restaurant, conference rooms, a spa, room service, valet parking, rates from $200 to $400 a night, and at the top, luxury and ultra-luxury. $500 a night is a starting point. The Ritz-Carlton, the Four Seasons, the Aman. These aren't selling a room. They're selling an experience so curated that the guest shouldn't have to think about a single logistical detail from the moment the car door opens. Each of these is a different bet on a different customer with a different cost structure. A budget motel and a luxury resort happen to both charge people to sleep in a bed. Financially, they have almost nothing else in common. Now let's talk about what it actually costs to create one of these things, because this is where the fantasy usually meets the first wall. A new construction hotel is priced per key. Per key means per room, and the number is bigger than almost anyone outside the industry expects. A budget property can be built for $75,000 to $125,000 per key in a lower-cost market. A mid-scale hotel runs $100,000 to $175,000. An upscale full-service property costs $250,000 to $400,000 per key. A luxury hotel in a major city, $500,000 to over $1 million per room. Build a 200-room upscale hotel and you've spent $50 million to $80 million before you've checked in a single guest, before you've hired a single front desk agent, before you've poured a single drink at the bar you just built. And that's construction. It doesn't include the land, which in any urban market worth entering is its own substantial number. It doesn't include the soft costs, architectural fees, engineering, permitting, legal, financing costs during construction, which can add 20 to 30% on top of the hard construction cost. It doesn't include the pre-opening expenses, hiring and training staff, stocking supplies, marketing, operating capital to cover the first several months before occupancy stabilizes. Then there's the FF&E, furniture, fixtures, and equipment, every chair, every mattress, every piece of art on the wall, the lighting fixtures, the bathroom hardware, the TV in every room. For a mid-scale property, FF&E runs $15,000 to $30,000 per room. For an upscale hotel, $30,000 to $60,000. For luxury, $100,000 per room or more. And here's what makes FF&E dangerous. It doesn't last forever. A mattress has a useful life of about 5 years under hotel conditions. Carpets in high traffic areas, 3 to 5 years. Lobby furniture, 5 to 7 years. The industry standard is to reserve 3 to 5% of gross revenue every year specifically for FF&E replacement. That reserve is not optional. A hotel that skips it looks fine for 2 years and then starts to feel dated in year 3 and visibly tired by year 4. And a tired hotel loses guests to the newer property down the street before those guests ever complain to management. So before your hotel earns a single dollar, you've committed to a number that for almost any serious property starts at tens of millions and climbs quickly toward 9 figures. Now let's talk about how a hotel actually makes money, because the answer is significantly more complicated than nightly room rates. The hotel industry measures itself with a metric almost nobody outside the business has heard of, RevPAR. Revenue per available room. Not revenue per occupied room, per available room, whether or not anyone slept in it. RevPAR is calculated by multiplying your occupancy rate by your average daily rate. If your 200-room hotel runs at 72% occupancy with an average nightly rate of $175, your RevPAR is $126. Every unsold room drags that number down. Every room sold below your target rate drags it down. RevPAR is the number that determines whether your lender calls to congratulate you or calls to ask questions. The industry average RevPAR for upscale hotels in the United States was around $110 to $130 in 2023, recovering toward 2019 levels after the collapse that COVID-19 delivered. In 2020, the global hotel industry lost an estimated $300 billion in revenue. Occupancies dropped below 25% nationally. Hotels that had been profitable for a decade went from generating cash to burning through reserves in weeks. Many didn't survive, because a hotel's costs don't stop when the guests do. Labor is the single largest operating expense in almost every hotel, consuming 30 to 35% of total revenue. And a hotel's labor structure is uniquely difficult to manage. A restaurant can send its staff home when the dining room is empty. A hotel cannot. Guests are checked in. They need things. Housekeeping has rooms to turn whether the house is at 40% or 95%. Security cannot be reduced because occupancy is slow on a Tuesday. The front desk needs coverage 24 hours a day, 7 days a year. A slow night doesn't mean fewer labor hours the way it might in almost any other business. It mostly means the same labor hours producing less revenue. Housekeeping alone typically accounts for a third of a hotel's total labor cost. A housekeeper cleans 12 to 16 rooms per shift. Each room takes between 25 and 45 minutes depending on whether it's a checkout or a stayover. In a union property, and many full-service hotels in major cities operate under union agreements, the labor contract specifies minimum staffing ratios, break requirements, and overtime rules that significantly limit management's ability to reduce hours when demand drops. Labor cost per occupied room at a full-service urban hotel runs $40 to $75. On a $180 rate, that is before you've paid a single other expense. The second cost that catches new owners completely off guard is the distribution fee. The website where guests book the room is not neutral. Online travel agencies, Booking.com, Expedia, Hotels.com, charge a commission of 15 to 25% of the room rate for every booking they deliver. On a $200 room booked through one of these platforms, the hotel receives $150 to $170. The platform takes the rest. Globally, online travel agencies now control somewhere between 35 and 45% of hotel bookings in most markets. In some European leisure destinations, it's higher. In major U.S. urban markets, it runs around 30 to 35%. This is why every hotel website has a best rate guarantee and why the front desk agent will always tell you that booking directly saves you money. It isn't altruism. Every direct booking saves the hotel that commission. A hotel running $10 million in annual room revenue and sending 40% of its bookings through OTAs is paying $600,000 to $1 million a year just in platform fees. That number comes directly out of the margin. Then there's the franchise, and this is where the economics of the hotel business reveal something most guests never think about. When you drive past a Marriott or a Hilton, you are almost certainly looking at a building that is owned by a private individual, a family office, a private equity firm, or a real estate investment trust. The brand, the reservation system, the loyalty program, the name recognition, the design standard belongs to Marriott or Hilton. The hotel owner pays for the right to use it. Here's what that payment structure looks like. A franchise agreement with a major brand typically requires a royalty fee of 4 to 6% of gross room revenue, paid monthly, regardless of whether the hotel is profitable. On top of that, there's a marketing or program fee of 2 to 3%, a contribution to the brand's central reservation system of 1 to 2%, and in many cases, additional fees for loyalty program administration, technology platforms, and training. Add it together, and a franchised hotel sends 8 to 12% of its gross room revenue back to the brand every month. Not of its profit, of its revenue. A hotel doing $8 million in room revenue and operating under a franchise agreement might send $800,000 to $960,000 a year to the brand in fees, whether the hotel made money or not. Marriott collected $4.4 billion in fee revenue in 2023. They did that while owning almost no hotels. They collected $4.4 billion from people who own hotels, built them, staffed them, and took on all the risk. That is what the asset-light model looks like from the other side of the agreement. And this brings us to the thing the hotel business is actually selling, which is not what most people think. The room rate is visible. It's what the guest sees when they book. But the room rate is one of the least profitable parts of the hotel's revenue mix. The food and beverage operation, the restaurant, the bar, the room service, the minibar, the coffee outlet in the lobby, generates margins between 70 and 80% on beverages and between 30 and 40% on food. The event and conference business is where full-service hotels make a disproportionate share of their profit. A 500-person corporate conference in your ballroom for 3 days generates room revenue from sleeping rooms, food and beverage revenue from every breakfast, lunch, dinner, and coffee break, and audio, visual, and event service fees. The same 200-room hotel that generates $13 million in annual room revenue might generate another $4 to $6 million from events, meetings, and food and beverage, with significantly better margins on key components. Parking is another one. In an urban market, self-parking at $40 a night and valet at $65 sounds small. Multiply it across 200 rooms and 365 nights at 70% occupancy, and you have a parking operation generating $2 million to $4 million on almost no incremental cost once the infrastructure exists. Resort fees, the fixed daily charge, typically $25 to $50, added to the room bill for pool access, fitness center, and Wi-Fi, have become one of the most controversial and most lucrative line items in the industry. Guests resent them. The Federal Trade Commission has moved to require clearer disclosure of them, but they persist because they work. A $35 resort fee across 200 rooms at 70% occupancy generates over $1.7 million a year in revenue that the OTA doesn't take a commission on because the platform commission is calculated on the room rate, not on the resort fee. The loyalty program is the final layer, and it functions in hotels almost exactly the way it functions in airlines. Marriott Bonvoy, Hilton Honors, and World of Hyatt are not really loyalty programs for frequent travelers. They are financial products that banks pay enormous sums to co-brand. American Express pays Marriott to attach its credit card to the Bonvoy program. Every time a cardholder swipes that card, or at a grocery store, a gas station, a restaurant that has nothing to do with Marriott, Marriott earns a revenue share from the bank. Marriott's total loyalty-related revenues and contributions represent billions of dollars annually, much of it from financial services activity that has nothing to do with anyone actually sleeping in a hotel room.
This is the hidden architecture of the modern hotel business. The flag on the sign is a financial product. The brand is selling access to its reservation system, its loyalty members, and its name recognition to investors who bear all of the operational risk. And the savviest players in the industry figured this out decades ago and restructured themselves accordingly. Now let's talk about what happens when things go wrong, because plenty of things go wrong in hotels, and they tend to arrive in clusters. A hotel is a physical building in a specific geography, and both of those facts create concentrated risk that diversified businesses don't carry. A natural disaster, a road closure that cuts off the approach, a crime incident at or near the property, a local economic downturn, a major employer leaving town, any of these can collapse occupancy at a single location with almost no warning. The hotel can't move, it can't pivot to a different product. It sits there, paying the same labor, the same franchise fees, the same debt service, while the guests go elsewhere. Renovations are another trap. Hotel brands require periodic property improvement plans, PIPs, as a condition of maintaining the franchise license. A PIP can require tens of millions of dollars in upgrades, new lobbies, renovated rooms, updated technology infrastructure, new fitness centers. If you don't complete the PIP on the brand's timeline, you can lose the flag. Losing the flag means losing the reservation system, the loyalty members, and the name recognition, the three things the franchise fee was supposed to buy you. Owners who have signed 15-year franchise agreements sometimes discover that the brand's renovation requirements can make the deal terms unworkable mid-contract, and the debt itself is a structural constraint that shapes every decision. Hotels are typically financed with debt equal to 60 to 70% of the total project cost, meaning a $60 million hotel carries $36 to $42 million in loans. At current interest rates around 6.5 to 7.5%, the annual debt service on $40 million runs approximately $3 million to $3.5 million per year. That payment is due whether the hotel is full or not, whether the economy is growing or contracting, whether a pandemic has shut down travel entirely or not. This is why Extended Stay America filed for bankruptcy in 2009, not because the concept was flawed, but because the debt structure couldn't survive the occupancy collapse that the financial crisis delivered. It's why dozens of independent boutique hotels that had operated profitably for years were wiped out in 2020 when their reserves ran out before travel demand returned. Scale didn't protect them. Revenue history didn't protect them. The only protection was liquidity. Cash reserves large enough to cover several months of fixed costs with zero revenue, and most operators had sized their reserves for a bad quarter, not a bad year. Now let's run two versions of this business side by side and see what owning a 200-room upscale hotel actually looks like over a year. In the optimistic scenario, the hotel is well located in a market with strong corporate demand Monday through Thursday and leisure demand Friday through Sunday. Occupancy runs at 74%, above the national average for upscale properties. The average daily rate holds at $185, in line with the competitive set. RevPAR lands at $137. Total room revenue for the year is approximately $10 million. Food, beverage, events, parking, and resort fees add another $4.5 million. Total revenue, $14.5 million. Operating expenses, labor, franchise fees, utilities, OTA commissions, FF&E reserves, insurance, property taxes, run at 68% of revenue, which is disciplined for a full-service property. That leaves operating income before debt service of roughly $4.6 million. Annual debt service on $40 million at 6.5% is approximately $3.2 million. Net income, around $1.4 million. On a $60 million asset, that's a return of about 2.3% on total investment, below what most investors would accept in any other asset class. But the property itself may have appreciated. And if the market is growing, the next year looks better. In the realistic scenario, a corporate account that represented 12% of room nights moves its preferred vendor to a competitor hotel that opened 6 months ago with a newly renovated product. Occupancy drops to 61%. A new OTA negotiation results in a higher commission rate. The brand requires a partial PIP, new lobby furniture, updated fitness equipment, refreshed in-room technology, costing $2.3 million, which the owner funds through a draw on their line of credit. A kitchen equipment failure takes the restaurant offline for 3 weeks during the fall conference season. Revenue ends the year at $11.8 million. Operating expenses, now higher due to the PIP costs and the additional debt service on the credit line, run at 76% of revenue. Operating income before the original debt service, $2.8 million. After debt service of $3.2 million, a net loss of $400,000. The hotel looks the same from the outside. Occupancy was still above 60%. The bar was still busy on Friday nights, and the owner lost $400,000 for the year. The gap between those two scenarios is $1.8 million, not from a catastrophe, from a corporate account defection, a commission rate, a kitchen repair, and a scheduled renovation requirement. So how do hotel owners actually build real wealth in this business? Not the way most people imagine. The best hotel investments are not primarily income plays. They are real estate plays with an operating business attached. A well-located hotel in a supply-constrained market, think a beachfront property on a barrier island, or a historic downtown property in a city that isn't building new hotels, appreciates in value over time. The operating business covers or nearly covers the debt service. The equity builds through principal paydown and asset appreciation. After 10 to 15 years, the owner sells the property for significantly more than they paid for it, and the total return, combining income and appreciation, justifies the investment in a way that the annual income alone never could. The operators who discovered this earliest also discovered that the brand was almost beside the point. The location was what mattered. A well-located independent hotel with no franchise fee, a strong direct booking strategy, and a loyal local following can outperform a branded competitor nearby because it keeps the 8 to 12% that the franchise takes and reinvests it into the product. The brand gives you a reservation system and loyalty members, but if you're in a destination people are already searching for, the Florida Keys, Napa Valley, a ski town with constrained lodging supply, guests find you without the brand's help. This is exactly why the boutique hotel movement grew so aggressively in the 2000s, and why brands like Marriott responded by acquiring Autograph Collection and Design Hotels, collections of independent properties that pay a smaller affiliation fee in exchange for access to the Bonvoy reservation system without having to conform to the full brand standards. It was an acknowledgement that the independent model had real merit and that the franchise model's value was shrinking in a world where guests could find any hotel on Google. So here's what you're actually buying when you sign the deed on a hotel. You are not buying a hospitality business. You are buying a real estate asset that happens to be operated as a hospitality business. The rooms, the restaurant, the event space, all of it is the mechanism that generates cash flow to service the debt that funds the real estate. If the location is right and the debt structure is manageable and the brand relationship is fairly negotiated, the hotel can generate income, service its debt, and build equity over time. If any one of those three elements is wrong market, too much leverage, a franchise agreement that extracts more than it delivers, the income disappears, the debt doesn't, and the equity erodes. The next time you check into a hotel and swipe the key card, consider what's actually happening. The brand on that card probably doesn't own the room you just entered. The owner of the room is somewhere calculating RevPAR, hoping your booking came through their direct channel instead of Expedia, and watching whether this month's occupancy will cover 11 days from now what the lender is expecting. They built the room, furnished it, insured it, staffed it, and paid a brand 10% of what you spent to use it. The hospitality is real. The business behind it is considerably less comfortable than the mattress,